There are three phrases that can make a routine banking transaction look much more suspicious than it needs to. But let's correct the headline immediately. There are no three magic words that automatically freeze your TFSA. A bank does not have a button that locks your account simply because you use the wrong phrase. What matters is the transaction itself, the surrounding circumstances, whether the activity fits your normal financial profile, and whether the bank has reasonable grounds to suspect money laundering, terrorist financing, or sanctions evasion. Certain answers can still create problems because they resemble indicators Canadian financial institutions are specifically trained to recognize. So let's look at three phrases that can raise compliance concerns, what they actually signal, and what Canadian banking rules require in 2026. This video is for educational purposes only and is not personalized financial, investment, tax, or legal advice. First, it helps to understand the difference between routine FINTRAC reporting and a suspicious transaction report. FINTRAC is Canada's financial intelligence unit. Banks, credit unions, securities dealers, money services businesses, and other regulated reporting entities have obligations to report certain financial transactions to FINTRAC. For example, when a reporting entity receives 10,000 Canadian dollars or more in cash in a reportable transaction, a large cash transaction report is generally required. Multiple cash transactions can also be combined under FINTRAC's 24-hour rule when they total $10,000 or more and meet the applicable aggregation requirements. That report does not mean the customer committed a crime. FINTRAC receives millions of large cash transaction reports. In the 2024 to 2025 fiscal year alone, FINTRAC received almost 2.9 million of them. And it is important to say cash. Depositing a check for more than $10,000 is not automatically the same thing as making a $10,000 cash transaction for FINTRAC reporting purposes. Different transaction types have different reporting rules. There is also no FINTRAC rule saying a $10,000 cash deposit automatically causes a 5 or 7 day freeze. Check hold policies, fraud reviews, availability of deposited funds, and anti-money laundering reporting are separate issues. Then there is a suspicious transaction report, usually called an STR. This is different. There is no $10,000 threshold for a suspicious transaction report. A reporting entity must submit one when it has reasonable grounds to suspect that a completed or attempted transaction is related to money laundering, terrorist financing, or sanctions evasion. FINTRAC describes that threshold as more than a simple hunch. The institution is expected to assess the facts, context, and relevant indicators surrounding the activity. And filing an STR does not automatically freeze an account. FINTRAC's own guidance recognizes that a financial institution may respond to suspicious activity in different ways. It might increase monitoring. It might reject or reverse a transaction where appropriate. It might contact law enforcement. Or it might decide to close a banking relationship. Those are potential actions. They are not automatic consequences of filing the report. There is also a reason a bank may not tell a customer that an STR has been filed. Canadian law prohibits disclosure of the report or the fact that one has been or will be made when the disclosure is intended to prejudice a criminal investigation. FINTRAC also warns reporting entities against tipping clients off to suspicious transaction reporting. With that distinction clear, let's get to the first phrase. I'd rather not say. Imagine someone arrives at a financial institution with a large amount of cash. The employee asks how the cash was obtained, and the customer responds, I'd rather not say. Maybe the money is completely legitimate. Maybe it came from selling a vehicle. Maybe it was accumulated business income. Maybe it was a gift. The problem is not that privacy suddenly became illegal. The problem is that refusing to explain the source of funds can become one piece of a broader compliance assessment. FINTRAC's current indicators for financial institutions specifically include a client refusing to identify a source of funds, providing information that is false or substantially incorrect, giving an insufficient explanation for the source of funds, becoming defensive when questioned, or presenting confusing details about a transaction. But one indicator does not automatically mean an STR must be filed. Context matters. The bank needs reasonable grounds to suspect that the transaction is connected to one of the relevant offenses. That is a much more accurate standard than saying one evasive sentence automatically freezes an account. For large cash transactions, the reporting process itself can require substantial information. FINTRAC's current large cash transaction report includes information about how the cash was obtained when that information is available. Examples include employment, a gift, or the sale of a significant asset. If information about the person or entity that was the source of the cash has been obtained, that information may also need to be reported. So if a financial institution legitimately asks for information about a transaction, the safest approach is not to invent a clever answer. It is to answer truthfully. If $15,000 came from selling a vehicle, say that. If it came from an inheritance, say that. If it came from legitimate business activity, explain that accurately and provide documentation if reasonably requested. And consistency matters for an obvious reason. The truth should not change from one conversation to the next. An inconsistent explanation does not automatically prove wrongdoing, but inconsistent or misleading information can add to the context a financial institution considers when assessing unusual activity. The key lesson is not, never say "I'd rather not say" or your account will be frozen. The better lesson is this. When a regulated financial institution is asking legitimate compliance questions about a transaction, evasive, contradictory, or false explanations can make an ordinary situation look much more complicated. Now for the second phrase. Can you split it? This one is much more serious. Suppose someone has enough cash to trigger a FINTRAC reporting requirement and deliberately asks whether the transaction can be divided into smaller amounts, specifically so the institution will not report it. That is not a harmless paperwork trick. Canadian law contains a specific offense dealing with structured financial transactions. A structured financial transaction includes a series of transactions that would have triggered FINTRAC reporting if conducted as a single transaction, and that are deliberately arranged with the intent that the reporting entity will not report the transaction. The law focuses on the intent to evade the reporting requirement. That means the underlying money does not need to be proceeds of crime for intentionally structuring transactions to avoid FINTRAC reporting to create a legal problem of its own. And trying to split transactions can fail for another reason. FINTRAC's 24-hour rule requires certain transactions to be aggregated. For large cash reporting, multiple cash amounts within a consecutive 24-hour period can have to be combined when they total $10,000 or more and are connected through the same conductor, beneficiary, or third party under the applicable rules. So imagine someone makes several cash deposits below $10,000. If those transactions fall within the aggregation rules and together reach the threshold, they may still be reported. And FINTRAC specifically lists attempts to structure deposits below reporting or identification thresholds as money laundering and terrorist financing indicators. It also identifies asking questions that suggest a desire to avoid reporting as an indicator financial institutions should consider. This area became even more significant after the Strengthening Canada's Immigration System and Borders Act, commonly known during the legislative process as Bill C-12, received royal assent on March 26, 2026. Among other changes, the legislation substantially strengthened the administrative monetary penalty framework, applying to reporting entities under Canada's anti-money laundering regime. For certain prescribed violations, the new framework can involve maximum penalties in the millions of dollars, with cumulative limits for entities tied in some circumstances to global revenue. That does not mean banks suddenly began monitoring transactions in 2026. Canadian financial institutions have had anti-money laundering obligations for many years, and structuring was already prohibited before 2026. What changed is that the compliance framework and potential consequences for regulated institutions became significantly stronger. So the lesson is straightforward. Do not redesign a legitimate transaction for the purpose of evading FINTRAC reporting. Conduct legitimate transactions normally. Provide accurate information when required, and keep documentation supporting the source and purpose of unusually large transactions when appropriate. A routine FINTRAC report is not something an ordinary customer needs to defeat. Now we come to the third phrase. It's not mine. This phrase becomes important when someone is conducting a transaction on behalf of another person. Suppose a family member gives you cash and asks you to deposit it into your personal account before sending it somewhere else. Or a friend wants money to move through your account because using their own account is inconvenient. The arrangement may have an innocent explanation, but from a financial institution's perspective, the question becomes obvious. Whose transaction is this really? Canadian anti-money laundering rules include third-party determination requirements. For example, when a reporting entity receives $10,000 or more in cash and is required to make a large cash transaction report or keep the corresponding record, it must take reasonable measures to determine whether the person providing the cash is acting on behalf of a third party. Third-party requirements also apply in several other specified situations, including certain account opening and reporting circumstances. So saying that money belongs to someone else is not itself prohibited. In fact, truthful disclosure may be exactly what the institution needs. What creates additional concern is hiding the third party, giving misleading information, or moving money through an account in a pattern that lacks an apparent economic or personal purpose. FINTRAC's suspicious transaction indicators include unnecessarily complicated movement of funds, activity inconsistent with the customer's normal financial profile, unusual use of multiple accounts, and funds moving into and out of an account over a short period. Again, none of those automatically proves money laundering. A legitimate family transaction does not become criminal because another person's money is involved. The bank looks at the circumstances. But if someone is genuinely acting for another person and the financial institution asks, hiding that fact can create a much bigger compliance issue than simply explaining it accurately. And this is where the original warning needs another correction. There is no evidence that saying, "It's not mine," automatically puts someone on a permanent banking blacklist that follows them from institution to institution. Suspicious transaction reports are confidential. They are submitted to FINTRAC under a specific legal framework. So it would be irresponsible to tell Canadians that one flagged transaction automatically creates a universal banking record that prevents them from opening an account elsewhere. What can happen is that an individual financial institution may decide a relationship no longer fits its risk tolerance or contractual requirements. That is a different claim. Now, there is one more issue that often gets mixed into conversations about frozen TFS. It actually has very little to do with FINTRAC. It is the CRA's rule against carrying on a securities trading business inside a TFSA. Normally, income and capital gains earned from qualified investments inside a TFSA receive tax-free treatment in Canada. But that protection has limits. If a TFSA trust is determined to be carrying on a business, the trust can become taxable on income earned from that business. There is no CRA rule saying that making a certain number of trades automatically converts a TFSA into a taxable trading business. There is no published rule saying 10 trades is safe and 100 trades is not. Whether securities activity constitutes carrying on a business is a question of fact. Factors developed through Canadian tax law can include the frequency of transactions, the length of time securities are held, knowledge of securities markets, the amount of time devoted to trading, financing, the nature of the securities, and the overall course of conduct. No single factor necessarily decides the outcome. A major court case confirmed how important this distinction can be. A professional investment advisor actively traded mostly speculative securities inside a self-directed TFSA. The dispute eventually reached the Federal Court of Appeal. In 2024, the court upheld the conclusion that a TFSA carrying on a business of trading qualified investments can be taxed on that business income. The fact that the securities themselves were qualified TFSA investments did not protect business income generated through a trading business. And there is a genuine difference between TFSAs and RRSPs here. CRA guidance explains that an RRSP or RRIF carrying on a business of trading qualified investments is specifically treated differently under the Income Tax Act. The RRSP or RRIF is generally not taxed on that business income when the activity is limited to qualified investments. A TFSA does not receive the same statutory exception. But this does not mean ordinary TFSA investors need to panic every time they rebalance a portfolio or sell an investment. The issue is whether the overall activity amounts to carrying on a securities trading business. buying ETFs, rebalancing periodically, selling an investment because circumstances changed, or making normal portfolio adjustments does not automatically mean someone is operating a trading business. The determination depends on the full facts, and this tax issue should not be described as the bank freezing the TFSA. The CRA assessing tax because a TFSA trust carried on a business is a tax matter. A bank restricting an account because of fraud or compliance concerns is a banking matter. A FINTRAC suspicious transaction report is an anti-money laundering reporting matter. They can occasionally intersect, but they are not interchangeable. So let's bring everything together. There are no 3 forbidden phrases that automatically lock a Canadian bank account, but certain statements can matter because of what they reveal about the transaction. I'd rather not say, can make source of funds questions harder to resolve, particularly when combined with other unusual circumstances. Can you split it? Becomes much more serious when the purpose is deliberately avoiding a FINTRAC reporting requirement, because intentional structuring is specifically prohibited under Canadian law. And "it's not mine" signals that a third party may be involved, which can trigger legitimate third-party determination and record-keeping obligations. The answer in every case is surprisingly simple. Do not invent a story. Do not conceal who owns the money. Do not deliberately structure transactions to avoid reporting. And do not assume that ordinary FINTRAC reporting means you are being accused of a crime. If the money is legitimate, and a regulated financial institution asks a legitimate question about the source, purpose, or ownership of a transaction, provide accurate information and appropriate documentation. And if your concern is your TFSA, remember that a completely separate tax rule applies. A TFSA is designed for tax-free saving and investing. It is not automatically protected if the trust is actually carrying on a securities trading business. The CRA looks at facts and conduct, not 3 magic words. That is the real warning for Canadian investors in 2026. The biggest risk is not accidentally saying one forbidden sentence. It is creating a transaction pattern that looks materially different from the truthful explanation behind it. Keep the transaction legitimate, keep the explanation truthful, keep the records when they matter, and understand which government rule you are actually dealing with before assuming your TFSA has been frozen.